GoToWebinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast.
多少？你可以帮我听这个吗？很好吗？我用佢啊，佢嗰日本嚟到手，你都手咁樣。 No, that one is he's muted, not unmuted. Testing.
Testing. Should I restart? Okay. To amplify because okay. Alright, welcome to Phillip Securities Research Weekly Market Outlook. Today we'll be covering a featured company, which is Amara, which Joshua will actually take you through later. In terms of last week, what we saw is that a technical sell-off, largely in equities and rates, as deleveraging followed after a hawkish shift in the Fed stance. Our base view has been that markets are largely in a correction mode. The sell-off last week was largely technical. The trend is still rather healthy, right? We also saw some signs of the global macro picture last week. In fact, we had some flash PMI releases, right? So to recap, what we saw is in China, the Chinese HSBC PMI, flash PMI for June is turning more negative, right? New orders are also contracting, right? In the US, on the contrary, there are little change in the US PMI readings, right? And remains firmly in expansionary territory. In the Eurozone, we reckon that things have actually turned an inflection point, right? In fact, the Eurozone PMI is turning less negative, although it's still in the contractionary territory. So the short of all these flash PMI readings is as such, we reckon that we should not expect going forth the China to actually do the heavy lifting in driving global growth, right? In fact, we think that there could be some positive upside surprises in the US and Japan economies, right? So in China also last week, the thing that was hogging the headlines was also the liquidity crunch, which has sort of eased at this juncture. But we think that that might not be the end of it. In fact, that risk on the horizon include a collapse of the shadow banking system, as well as some state-owned enterprise, which could actually certainly trigger some jitteriness among investors. But our view is that the Chinese government, at some point in time, if things turn serious, will actually step in and intervene. The base case has always been that our view and their views also that structural reforms are in fact more critical than monetary and fiscal stimulus in ensuring a sustainable economic growth for the Chinese economy. Moving on to another asset, which are commodities. We think that it's likely to be confronted with structural headwinds, especially when Chinese factories are rather sluggish at this juncture, and the use of commodities in economic production would be hence less intensive, right? So continued monetary easing might not be able to excite commodity bulls, right? Okay, so for the S&P 500, last week we saw a bounce up last Friday, but we think that it might be a dead cat bounce. In fact, it's looking quite vulnerable, right? It's collapsed below its 50-day moving average as well as psychological 1,600 level. The key thing to watch out for the US will actually be your new home sales data, which will be out early this week, right? So this key data point will actually be the first reading after a substantial increase in mortgage rates. So you get a sense of how the US economy is reacting to such an increase in rates, mortgage rates. For the Nikkei, we think that we could be seeing the end of a corrective wave, right? In fact, that this morning it's struggling to stay above 13,000 level. So as long as it stays above 13,000 level, the odds are that we could see a bounce up for the Nikkei. HSCI it's in a downward bias. This morning it's still hugging its lower Bollinger Band, right? Same for HSI. In fact, for both indices, it has collapsed below the 50-day moving average as well as the 200-day moving average support level for reasons that we have mentioned earlier on about our concerns about the Chinese economy. For the STI, we think that the bulls had to defend the 3,100 level, right, which was briefly tested on Friday. So 3,100 would be the temporary support for your STI. For the Thai index, it's looking quite vulnerable. It's fallen through the 1,400 level, key support level, as well as your 200-day moving average. For the Jakarta Composite Index, it used to be one of the more resilient ASEAN indices, but then it has fallen below its 200-day moving average support level and 4,600 level, psychological level. So in fact, what we saw for Indonesia essentially is that last week we saw the fuel price hike being implemented. So in terms of your diesel, in terms of your gasoline, you're seeing hikes of around 22 to 44%. But the Indonesian government has actually preempted this to some extent by anchoring inflation expectations by actually introducing an off-cycle 25 basis point hike to your FASB as well as your policy rate. KLCI, it's consolidating. It's one of the more resilient, or rather it's the most resilient asset in this right now. But even that, it looks vulnerable after piercing through its 50-day moving average support level. With that, I'll pass on to Joshua, who will take us through Amara.
Morning, everybody. Thank you for logging into our webinar. Today we initiated on Amara, and I'll take you through the company. Basically, we think it's a buy as the company has a rather clear growth profile ahead. The price when we did the slides was 565, and I think it's up by 2 cents today. Okay, a bit of history about the company background. It was incorporated as Teo Teck Huat Enterprise, CEO Albert Teo's father, and but in 1995 they changed the name to Amara, and listed on the SESDAQ, and then on 2000 on the main board. Now it's got 3 business segments, the first of which is the Hotel and Investment and Management segment, then the Property Investment and Development. So the Property Investment holds non-hotel assets like commercial and retail, and it also books in development profits when it develops residential units. There's a third business segment, which is Restaurants and Food, which is a smaller segment for the company. Okay, the management is Mr. Albert Teo, son of the founder, and the family has a 67% shareholding of the company. So the interests are aligned with shareholders. And going ahead, there's improving profitability in its current assets, and we see aggressive expansion overseas, and is actively seeking overseas opportunities. Okay, in terms of gross asset value, the hotels comprise the largest, followed by retail space, and then office space, and then residential space. And in terms of revenues, hospitality takes in the most, followed by property investment and development. In terms of profits, they're pretty evenly split between hotels and other non-hotel assets. But in terms of asset backing book value, it's mainly in hospitality assets. This is because there is quite a bit of development going on for its hospitality assets. Okay, now we'll just do a short recap on the industry background before we launch into going through the assets of Amara. So if we just take a look at Singapore's hospitality outlook, STB targets 17 mil visitors by 2015. 14.4 million were achieved in 2012, and this year is on track to achieve 15.4, haze notwithstanding. Okay, beyond 2015, STB estimates that 3 to 4% growth in arrivals is sustainable. Now, tourist receipts are expected to increase as the proportion of stopover trips actually reduces and longer stay trips increases. Okay, this is something to do with the IRs that have been opened, and of course Singapore itself has many new attractions opening up. And also STB is looking for new initiatives with a $5 million Kickstart fund, a small fund, but it's meant for innovative tourism initiatives. Okay, so the quality of visitors actually is also getting better. As you can see, the top 5 proportions of visitors: Indonesia, China, Malaysia, India, especially those have high GDP growth rate countries. So we can expect that their spending power would increase over time. In terms of hotel demand and supply, you can see that the number of hotel rooms are increasing and that there is some net supply. However, we do think that although there's going to be a little bit of downward pressure on occupancy levels and resistance to RevPAR because of this, we don't think it'll be detrimental excessively detrimental to current rates. Okay, so as you can see there, the island average of hotel occupancy is about 85%. That is the top left panel. Amara Singapore and Amara Sentosa are below that, but increasing, and this is one of the upsides that we will be talking about. Now, the chart on the bottom shows the average room rates. Okay, and we will also be showing that Amara Singapore has some catch up to do. Now, so let's go on to Amara Singapore. Okay, it's you probably have seen this hotel before. It's at Tanjong Pagar. It is their flagship hotel, a 4-star 380 room hotel, which makes up just above a quarter of gross asset value, a 9-year lease that has started since 1979. Okay, the current occupancy is only 75, so you may ask why so low? Well, that's because it's undergoing a refurbishment in the interior. The other thing, 100 AM, which is the mixed development that is attached to the hotel, has also been going through refurbishment. Okay, so those two things combined have definitely affected occupancy. Okay, but all that is over now, and in the fourth quarter of last year, they were completed. So we expect to see a recovery of RevPAR from 155 to 180 this year. Okay, the valuation of this hotel, we have it at 259.2 million at 682,000 per room. Okay, it's based on a what we think the RevPAR will recover to of 180 and a 6% cap rate. Now, the national average RevPAR is 200 to 250. So for this class of hotel, so we actually think that there is going to be some upside here. Okay, Amara Sanctuary is their luxury resort in Sentosa. It comprises 13% of gross asset value. It's a 5-star hotel, 140-room hotel. It also saw a refurbishment in last year, rather addition of rooms, right? I think it added about 40 rooms last year. So we should see, greater earnings from this asset going forward. So on a 70-year lease, started in 2007. Okay, RevPAR upside, like I just mentioned, additional number of rooms, but also the increased commercialization of Sentosa. Sentosa has had a remarkable 19 million visitors. That's because you also count Singaporeans going into Sentosa, and it's got plenty of attractions. The iFly, 1 degree 15, the IRs, and certainly I bring my kids there pretty often. The valuation's at 129 million or 922,000 per room. Okay, and so we have based our valuation on a RevPAR of 225 and a 6% cap rate. Okay, now we're going to go on to where the growth is coming from, right? We've taken you through 2 hotels which are already in operation. So now this is Amara Bangkok, which we have very conservatively valued. So at our current valuation, it's only comprising 4.3% of GAV. All right, it's under construction and will be completed in 2014. Now located on Surawong Road, parallel to Siloam and Southbound Roads. Okay, it's actually a very strategically located hotel, which is very close to the financial district of Bangkok. So our sources there tell us that it's a stellar site basically. It's a 251 room 4-star hotel that targets both leisure and business. Okay, we have valued it very conservatively at 73 million or 292,000 per room. Okay, this is based on a RevPAR of 160 at a 10% cap rate. Right, the conservative estimates we have put down to reflect that the management of Amara actually lacks overseas experience. Right, the average RevPAR in Bangkok for this kind of asset is about 200. So we're doing it very conservatively. Now, the impact of Amara Bangkok we have estimated in 2014 to be half a year of operations at 65 occupancy, being a very new hotel. Okay, the next asset is going to be in Shanghai. This one will be open in 2015. Okay, so you see that Amara has an asset that is going to kick in 2014 and then one more in 2015. All right, so this asset is in Shanghai. It's on a 40-year lease that expires in 2037, and it's a mixed-use development. All right, that's a hotel at 205,000 square feet, a retail space of 130,000 square feet, an office space of 80,000 square feet. It's going to be a 5-star, 336-room hotel. It's under development to be completed in 2015. Now, we will go through the retail and office valuations later, but we'll just talk about the hotel right now. Also very conservatively valued at 79,235,000 per room, based on a RevPAR of 173 with a humongous cap rate of 17.50. Okay, so these are very conservative estimates, is to also reflect the lack of overseas experience. Now, average RevPAR in Shanghai is around 260 for the 5-star range. So you can see we've put a huge discount on it. Okay, now let's move to the retail assets. Okay, Singapore has a buoyant retail sector driven mainly by tourists, right? As you can see that Singapore is becoming a choice, a top tourist choice. We offer lots of attractions, F&B outlets, retail malls in Singapore. And over the recent 12-month period, Singapore has seen numerous international brands opening up retail and F&B outlets along the Prime District. Okay, so there is a increasing array of shopping and dining options afforded by these openings, and consumer spending is starting to recover and showing positive growth in early 2013. Okay, so the flagship retail mall, which is attached to Amara Singapore, if you've been to Tanjong Pagar, you will know that it is practically the only mall that is in that area. And I think that is one of the key selling points of this mall, being the only one in that area. The residents at Tanjong Pagar use it pretty frequently if you go down to the mall. And of course, during the daytime and the weekdays, you get the office crowd. Okay, so it was formerly known as Amara Shopping Center, and it has undergone a huge asset enhancement initiative that was completed in the 4th quarter of last year, which cost 30 mil. So this year, 2013, is going to see full year earnings, right? The net lettable area is 121,000 square feet and is currently 100% occupied. Still, we see further upside, even though the mall is fully leased, on increased footfall from increased catchment of residents. If you've gone inside, you can see that the tenant mix is rather attractive, okay, to attract residents from the area to go in with lots of F&B options. Numerous condo projects are also coming up around it, the Altex, Sky Suites, and PS 100. Okay, so this forms 16% of Amara's GAV, is valued at 159 mil, 1,300 PSF NOA, and it's based on gross rents of $9 PSF and a cap rate of 5.75%. Okay, now in Shanghai we said that it's a mixed development, so there is going to be a mall that is that will be attached to Amara Signature Shanghai. Now, if you look at the top left chart, although the growth rate of retail sales in Shanghai has slowed to 8%, it still outperforms most other regional cities, and it's indicative of consumers' growing purchasing power and confidence. Also, the demand for retail space in Shanghai has not has not faltered since 2004. So if you look at the bottom left chart, new supply, which is the blue bars, is pretty much taken up rather swiftly. So you look at the net take-up, it's pretty close to the blue bar. Vacancy rates about 8%. Okay, so the retail asset location is highly favorable. Puxi is a historic center of Shanghai and continues to house the largest proportion of residents within the city. This asset is going to form, we estimate to form 11.2 of Amara's gross asset value, and it is valued at close to 112 million, or just over 1,000 PSF, based on gross rents of 750 PSF and a cap rate of 575. Okay, now let's move on to the office assets. Amara Singapore is also, it's Amara Singapore, 100 AM, the retail mall, and 100 AM medical offices are all in the same location. So 100 AM medical offices was called Amara Corporate Towers before. It's a 12-story office tower of 36,600 NLA, 99-year lease from 1979. Okay, due to the recent influx in new office space in that area, we have seen rents under pressure. However, management has decided to embark on a new strategy, which is to basically convert this into a medical-themed space. Okay, so the tenant mix is currently being reallocated, or rather rebalanced, as existing tenants leave. They fill it up with medical offices. Okay, passing rents right now are about 9 PSF, and if you know anything about medical office spaces, actually the rents can double from here. However, we're not factoring that in yet. Okay, the value of the development is nearly 52 million, 1,400 NLA at 5.75 cap rate. Now, Amara's signature Shanghai, the office space is it was twice the size as the Singapore one, as 80,000, or GFA so far. Okay, strong demand from local firms for office space in the city. Okay, we do not see any drastic correction in office rental space yet, even though there's lots of supply. Passing rents are about 5.5 PSF, and we value the asset at 63.4 million, 990 PSF, based on a cap rate of 4%. Okay, so now these are the assets that we've gone through are the assets that pretty much there already. Okay, those are, we know that Bangkok will be done in 2014. We know that Shanghai will be done in 2015. So there is a potential other catalyst, though, and that is Myanmar. Okay, so if in Myanmar, it's a country that's moving towards democratic rule. US and Eurozone have mostly removed the trade sanctions, and Korea and Japan have both waived their debts, the debts that Myanmar owes them in exchange for increased involvement in the country's infrastructure projects. Now, the number of tourist arrivals was close to 400,000. However, if you look at the number of rooms, it's maybe 14,000. Okay, so there's a huge lack of supply of rooms there, and so we see a huge opportunity actually for more hotels in Myanmar. Okay, for Myanmar, however, it's actually still in the MOU stage, so there's nothing set in stone yet. So let's just move on to the earnings outlook for Amara. Okay, for 2013, we're not forecasting a huge increase in earnings from the previous year. Basically, 21 million this year from 20 million last year. That is the flow through down to PATMI and excludes all fair value adjustments, which can be quite substantial. Okay, what we see basically is that this year is for 100 AM to book in full year earnings, and RevPAR normalization for Amara Singapore. Okay, but the big increase is going to come in 2014, so that's next year, which is about 6 months away now. And you know, markets look with a 6-month lead time. So the substantial increase in earnings is going to come first from Amara Bangkok, right, which we estimate to complete next year. And like we told you, we are only going to be, our 39 million adjusted net income forecast basically includes from Amara Bangkok 6 months of operating earnings at 65% occupancy. Now, the second thing that's going to drive earnings is the continued RevPAR normalization of Amara Singapore. And actually, there are 2 property developments that are going to be, that are actually pretty much fully sold. I mean, City Life Tampines is fully sold, and Killiney 118 is has only 1 unit outstanding. But the earnings are going to be booked in next year. Okay, so you'll see a huge adjustment in, or rather huge increase in net income from 21 million to 39 million, and that is our forecast. Okay, in terms of dividends, I don't think you should expect much of dividends from Amara because it's in the growth stage and will therefore retain most of the capital in what is a very capital-intensive industry. For CAPEX, we estimate that Amara Shanghai is going to cost further 50 mil, and Amara Bangkok another 24 mil, and the upcoming hotel in Myanmar, if it does happen, will cost them about 26 mil, and we have built these into our financials. And so if you're thinking that, you know, maybe there might be quite a lot of gearing risk, actually, because the current assets are going to be throwing out a lot of cash. Cash flow from operations, I think, is going to pretty much be able to fund most of the CAPEX going forward. Okay, so we don't see that the gearing is going to return to historic high levels. We initiate with a buy. The current price of, 56.5 cents on Friday, well, I think now it's 58.5, indicates that this thing is, Amara is trading at a 50% discount to RNAV. So, and so if you actually just look at the panel on the left, all right, the development properties are going to value it at about 59.7 million, and then investment properties, hotels, are forming the main bulk of it, right? More than 900. I mean, so sorry, the hotels, retails, and office. These are the recurring income assets of the group, and their gross asset value is over 900 mil. Okay, so you net off, put a bit of a discount to, well, you net off the net debt, which is about 200. So you get about 790, which is the net GAV, and then you take a bit of a holding company discount of 10%. So we get the RNAV at 711. Okay, so the RNAV per share works out to be $1.23, and if you take a huge discount of 40% to it, that's how we got our fair value price of 74 cents. Okay, so at the current price of 565, I mean, if you go back to the text that we wrote on the right hand side, the second point under current price of 565. Okay, the Singapore assets are themselves valued at around 80 to 90 cents. So you're already buying the Singapore assets at a massive discount, and then you're getting all that growth for free. Okay, and that growth is a clear growth profile. It's not up in the air. It's already happening, right? Amara Bangkok and Amara Shanghai, which are under construction. So our very conservative target price of 74 implies an upside of about 30% from where we are now. So we like to reiterate that this is a very conservative valuation, and so we see lots of upside and actually a continued story going to 2014 and 2015. Okay, with that, I thank you, and we can take questions over the webinar and from the floor, because we have a bit of a studio audience here today. Right. Can ask questions on the market, can ask questions for companies under our coverage. You can just type them in and we will try and answer them. Okay, there is a question here on why were SIA Engineering and Bowsett taken off your recommended list. Actually, SIA Engineering, we're having a change of analyst. Okay, so we had to remove it. Although we're still very positive on the company, and once we get a new analyst to take over coverage of SIA Engineering, we will consider putting it back on again. Okay, Bowsett I cover. I think one of the reasons, the reason why we took off Bowsett is it's not because also we're bearish on the company, but we see that our other picks, which are Keppel Corp and SGX, and Peng United had a better upside from where we were at that time, so we had to rejig that list. But fundamentally for Bowsett, not much has changed. Oh, the only thing that could hold up Bowsett back, actually I forgot to mention, is that the weak Australian dollar. All right, because Bowsett's operations from its geospatial division, a bulk of it comes from Australia, so the weak dollar there may have something to do with it. So, but it's growing at a 12% growth rate. So the current depreciation of the Aussie dollar might have some effect on the earnings there. Okay, for target price of 74 cents, what a timeline for our hit. The timeline is we have a 12-month target.
Because this is gross rent, but gross rents you have to take out all the way what you take net property income divided by cap rate, get your valuation, not gross. So it's better.
Hi, CJ Ng has a question here on whether he could take the $9 PSF and divide it by our cap rate for 100 AM to get 1878 PSF. No, you can't do that, because actually you have to take the net property income to divide that by the 5.75. Okay, so you have to, because the $9 PSF is gross rent, so you have to, that actually gives revenue, and then you start minusing off expenses, and then when you get net property income, then you divide that by the cap rate.
Hey, do you want to talk about
Hi. Yep. There's a question from the floor with regards to whether or not we are able to speak. Unfortunately, because this is a webinar, we will only be able to answer questions through typing. Another question on OUE on whether there's any change in status since for OUE there is currently no change in status. The third question on whether what's our house view on the REIT sector? Is it a good time to buy in as the price has come off a bit? For the REIT sector, in broad, our view is that there is unfortunately rather limited growth in the REIT sector. For the REIT sector specifically, we would recommend that the investors look into the REITs from a bottom-up approach, meaning to look at each individual counter and choose the counter in which it's likely for the manager to be able to implement good year-on-year growth in rental yields.
All right. With regards to this question about when do we actually see the Singapore market actually bottoming out and the near-term macro risk. Now, I think to answer this question, let's take a step back. As we saw just now in our earlier slides on the charts, what we're seeing is that across ASEAN, most indices are actually looking quite vulnerable, right? So, I mean, if we have policy tightening in the developed markets such as US, right, then you will see funds actually flowing out from ASEAN, which was the story of 2012, into the US, right? And hence, correspondingly, what we saw was actually indices across ASEAN actually looking quite vulnerable. In fact, we think that a renaissance of the US economy will actually lift up the Singapore market, right? So, in fact, we think there's some upside to the Singapore market. From a technical perspective, in terms of downside, if it breaks below 3.1, which is tested last Friday, we think that there could be some, if it breaks below 3.1, then we think that there's downward bias for the index. But on a medium-term perspective, a recovery in the US markets will actually lift Singapore market much more so than its other ASEAN counterparts.
Hi, there's a question here on what risks should we look out for Amara. Good question. I think the key risk is that they have never operated an asset overseas before, right? And our growth story is basically predicated on Bangkok and Shanghai being successful hotel and mixed development assets. Okay, so they've never done this overseas before, so I think that's a key risk. But I think, if you go to the local assets, both pretty well run. So it's a question of transporting their expertise overseas.
Hi, there's a question on our view of the property counters at the moment. For the property counters, our view is that right now, for residential specifically, the cooling measures from the government, and also we also expect a huge supply coming on board soon. These two factors are expected to add some pressure on property prices, and that would adversely affect the residential property counters. Also, right, for property, given that it's somewhat a high dividend yielding counters, the potential rise in interest rates will also cause further pressures on the property counters. Another question would be, how will the tapering affect the STI, the yield stocks, and the REITs if they do come? Okay, so the impact of translate it. Okay, so the impact of this would be that with the increase in the tapering of QE, right, would have an indirect one, but the one that's more direct would be when that the Fed intends to increase interest rates at at around possibly our house takes around 2014 and consensus is around 2015. So with this increase in potential increase in Fed rates, right? Typically long-term long-term interest rates would start already to move upward. And when this happens, then people would demand a higher interest rates, higher yield. And with the demand for higher yield, we see that this would result in prices coming down for high-yielding stocks, including the REITs. To note is that we are positive on the telcos because even though they also belong to the class of high-yield stocks, but for the telcos, we see that they are more resilient because they also offer very good growth opportunities. Are there any more questions for us? With that, thank you for attending this webinar and look forward to your continued participation next week. Same time. Thank you.